For years, we were told the system was stable, that risk was managed, that safeguards were in place. We were told the numbers were complex but under control, that only experts needed to worry about them. But buried beneath the headlines, beneath the stock charts and interest rate debates, something far bigger was growing, something so massive it defies comprehension. A $4,500 trillion derivatives market, not sitting in one place, not owned by one institution, but woven through every major bank, fund, government balance sheet, and pension system on Earth. This wasn't built overnight. It was constructed slowly, quietly, during moments of crisis when fear made people accept anything that promised stability. And that's the part no one wants to admit. This system was never designed to be safe. It was designed to delay collapse by pushing risk forward in time. Derivatives were sold as insurance, as protection, as tools to smooth volatility. But insurance only works when the insurer can actually pay. What happens when everyone needs protection at the same time? What happens when the guarantees themselves are backed by leverage, and that leverage is backed by more leverage? And somewhere down the chain there is nothing real left to grab onto. The answer is uncomfortable, because it exposes a truth we've avoided for decades. This entire structure depends on confidence, not value. It depends on the belief that counterparties will perform, that markets will remain liquid, and that central banks will always be able to step in with unlimited firepower. But belief is fragile, and once it cracks, no spreadsheet can fix it. This $4,500 trillion figure isn't just a big number meant to scare people. It represents layers upon layers of promises. Interest rate swaps betting on future policy, currency derivatives hedging against instability, credit default swaps wagering on failure, and synthetic instruments that multiply exposure without creating anything tangible. $1 of real economic activity has been used to support dozens, sometimes hundreds of dollars in financial bets. That's not growth, that's distortion. And every distortion requires constant intervention to keep it from snapping back to reality. Low rates, emergency lending facilities, asset purchases, quiet bailouts, these weren't temporary measures. They became the foundation holding this structure upright. The danger isn't that everyone suddenly realizes how big the derivatives market is. The danger is that one critical assumption fails. A major counterparty misses a payment. A currency move breaks a hedge. An interest rate spike turns manageable exposure into instant insolvency. When that happens, the chain reaction doesn't move slowly. It moves at machine speed. Algorithms pull liquidity. Margin calls fire automatically. Positions that were considered safe yesterday become radioactive today. And because these instruments are so interconnected, stress in one corner of the market doesn't stay contained. It spreads through balance sheets, through clearinghouses, through institutions that never thought they were exposed. People like to believe regulators see everything, that stress tests account for worst-case scenarios. But stress tests are based on models, and models are built on past data. This system has never been stress tested under conditions where trust evaporates globally at once. We've never seen what happens when sovereign debt, currencies, and derivatives all come under pressure simultaneously in a hyper-connected world. And here's the uncomfortable part. Regulators didn't miss this because they were incompetent. They tolerated it because the alternative, letting the system reset, was politically and socially unthinkable. Every crisis was met with more leverage, not less, because unwinding the existing structure would have exposed losses no one wanted to explain. That's how we arrived here. Not through one mistake, but through 1,000 temporary solutions that became permanent. Each time the system wobbled, more complexity was added to hide the cracks. Each time volatility spiked, new instruments were created to suppress it, and every suppression required even greater force the next time. This is why the derivatives mountain matters so much. It tells us the system no longer absorbs shocks, it amplifies them. Stability itself has become destabilizing because it encourages risk-taking on a scale that only works as long as nothing goes wrong, and nothing ever goes wrong until it does. When people hear numbers like $4,500 trillion, they instinctively assume it's abstract, disconnected from daily It's not. These positions sit behind pension returns, insurance policies, government borrowing costs, and bank solvency. They influence whether ATMs work, whether credit flows, whether businesses can roll over debt. When derivatives unravel, it doesn't stay on trading floors. It reaches households through inflation, through lost savings, through sudden restrictions that are always described as temporary measures for stability. That's why this matters now, not later. We're at a point where the margin for error has disappeared. Rates can't rise much without breaking something. Liquidity can't dry up without triggering forced selling. Confidence can't waver without exposing how little substance is left beneath the promises. The system survives not because it's strong, but because everyone involved believes it must survive. That belief has carried us this far, but belief alone cannot support a $4,500 trillion web of obligations forever. What people often misunderstand about a CE like this is the timing. They imagine a dramatic headline, a single red candle, a crash that announces itself loudly. But that's not how systemic failure usually arrives. It arrives quietly, disguised as a technical issue, a temporary pause, a weekend event meant to restore order. Black Sunday isn't about markets falling, it's about confidence vanishing. And confidence, once gone, doesn't come back because someone says the right words at a press conference. The global financial system doesn't run on cash, it runs on trust. Trust that payments will clear, that collateral will hold its value, that counterparties will still exist tomorrow. The moment that trust breaks, liquidity evaporates, buyers disappear, sellers panic, and suddenly prices don't reflect value anymore, they reflect desperation. This is where all the safeguards people believe in begin to fail, because safeguards assume orderly behavior. They assume markets function normally. Panic doesn't care about assumptions. When confidence cracks, everything accelerates. Funds that rely on overnight lending find doors closed. Banks stop trusting other banks. Clearinghouses demand more collateral, right when collateral is hardest to find. Margin calls cascade automatically, forcing sales into falling markets. This isn't human decision-making, it's mechanical. Systems react exactly as they were programmed to react, and those reactions amplify the damage. The irony is brutal. The very systems built to manage risk end up spreading it at maximum speed. Central banks are often presented as the ultimate backstop, the final line of defense. And for a long time, that illusion held. When crises appeared, money was created, assets were purchased, rates were cut, and confidence was restored, at least temporarily. But every intervention came at a cost. Each rescue increased dependence on the next one. Each bailout taught markets that risk would be socialized and losses would be postponed. Now we're facing a moment where the usual tools don't work the way they used to. Rates are already elevated. Balance sheets are bloated. Inflation limits how aggressively money can be printed without consequences. The firepower exists on paper, but credibility does not. This is where Black Sunday becomes different. No. Because policymakers won't act, but because markets may no longer believe their actions can fix the underlying problem. You can inject liquidity, but you can't inject trust. You can promise stability, but you can't force people to lend when survival is the priority. When fear takes over, institutions don't think about returns, they think about staying alive. And when everyone is in survival mode at once, the system freezes. For everyday people, this phase never looks like a financial theory. It looks like confusion, accounts temporarily limited for security reasons, markets closed to prevent disorderly trading, sudden policy announcements over a weekend. These measures are always framed as protective, as necessary to calm markets, but they also reveal something critical. Control is slipping. The illusion of a smooth, always functioning system gives way to emergency management, where decisions are made quickly and transparency becomes optional. This is how the cost of collapse is transferred, not evenly, not fairly, but predictably. Large institutions negotiate, governments restructure, central players get time, ordinary people get inflation, reduced purchasing power, and rules that change after the fact. Savings lose value quietly, wages lag behind prices, access becomes conditional, and the public is told this is unfortunate but unavoidable, the price of preventing something worse. That's the real shockwave of Black Sunday, not a single market move, but a shift in how the system treats those who depend on it. What makes this moment especially dangerous is how interconnected everything has become. Markets don't fail in isolation anymore. A currency problem becomes a bond problem becomes a banking problem becomes a sovereign problem, and because information moves instantly, panic spreads faster than any official response. By the time explanations arrive, positions have already been unwound, losses already locked in, damage already done. And here's the part no one likes to say out loud. This outcome isn't an accident. It's the logical conclusion of decades of financial engineering designed to maximize short-term stability at the expense of long-term resilience. Complexity replaced simplicity. Leverage replaced prudence. Appearances replaced substance. The system grew larger, faster, and more fragile, while everyone involved convinced themselves that sophistication equaled safety. It didn't. It just made the breaking point harder to see. Black Sunday, then, is not a date on the calendar. It's a threshold. A moment when people realize the system they trusted doesn't work the way they were told it did. When the promise of perpetual stability is exposed as a temporary illusion. When power shifts, not always visibly, but permanently. After that moment, the rules change. Capital behaves differently, governments behave differently, people behave differently, and whatever emerges on the other side will not resemble what came before.